Good evening, traders and investors. Will back here with another one, coming to you with a Wednesday market recap. Hopefully you guys had a very good day in the markets today. And in today's action, well, we had a bit of a big sell-off. The S&P down 0.5%, but was down as much as 1%, and the Qs ending the day down 1%, but was down as much as 1.75%. So the headlines will lead you to believe that today was a very big red day in the markets overall. However, when we dig a little bit deeper, you will see that once again, it is the same rotation that we've been talking about over the course of the past 2 weeks since the beginning of the year. Take a look at the heat map right here. Once again, big tech lagging behind, and the rest of the market there to kind of uphold everything. The rotation into the cyclical aspects of the market simply continues at this point. And the context behind this matters a whole lot, and you kind of have to go back over the last few years to understand what's happening and why. We've covered it many times on the channel, but just to give it one more go in the event that you're new or perhaps you haven't seen some of the videos in the last 2 weeks, it's important to remember where we are in the grand scheme of the market cycle. Coming out of 2022, of course, we had record amounts of inflation and also very high interest rates. And then into 2023, there was a safe haven trade, one trade that made a lot of sense because it was a cash flow light model, generating tremendous amounts of margins, and they were very solid companies with worldwide presence, able to generate revenues in spite of some macro concerns at the time, which were high inflation, high interest rates, and a very weak consumer. And that safe haven trade was big tech. And that lasted all the way through 2023 and into early 2024 when big tech got the second batch of life breathed into it from the AI trade, from NVIDIA and AMD ramping up their efforts and people building data centers all over the place to capture this new AI trade. And that lasted from 2024 all the way through last year, 2025. And that is even in spite of a massive tariff sell-off that we got last April. However, a few things have changed into the early part of the year. And no, the things that have changed is not that big tech is a disastrous trade with dwindling margins and dwindling moats. No, that is still very much the same. But one thing that has changed is the macro backdrop is a lot more clear heading into 2026 than it ever was out of 2023, 2024, and even into 2025. And the backdrop is as follows. We've covered it many times on the channel, but just to reiterate, we have many bullish tailwinds, guys, now that you have not been able to confirm in the past 2 or 3 years for various reasons, because of the weakness of the consumer, because of the high inflation rates, which were reiterated again as a second concern after tariffs, right? And just the overall status of the economy was somewhat unclear. The projections for a recession were still somewhat high from a lot of the investment banks, 25, 30% recession odds in 23, 24, and 2025. That never materialized. But now into 2026, you got a lot of very bullish catalysts. And we've talked about these. You got very strong GDP. We got a 5.4% GDP projection just the other day from the Fed, right? 5.4% for Q4, definitely not recessionary there. You got rate cuts, finally, and an end of quantitative tightening, which eases some pressure and loosens financial conditions. You got relatively low unemployment still. We got that just the other week, 4.4%, very low in terms of historical averages, even though it's a no hiring, no firing economy. You got low-ish inflation, right? Everybody thought that there would be a big second wave of inflation coming out of tariffs. That wasn't the case. We've been dealing with high inflation for the last 3 years, guys. When we take a look at the Trueflation Index, it's at 1.72 right now. We literally just got CPI the other day. It's at 2.7, but CPI is not the best way to measure a traditional basket of goods and services. I much prefer Trueflation because it measures 15 million different products on a daily basis. Then you also have very strong earnings estimates. I will remind you, the S&P 500 earnings growth projections for 2026 are about 15%, which is very, very strong here, guys. Not that one, the one from FactSet Predictions, right? This one right here, 15%, which is far above the past trailing years. A past 10-year average was 8.6%, right? You have very strong earnings. You got the AI megatrend, which is still in place, although slightly paused for now, especially if you look at big tech and a lot of semiconductors. And then you got massive fiscal policy, the big beautiful bill, $4 trillion in tax cuts, and additionally, a lot of deregulation as well. So what has the market been doing? Because now the picture is a bit more clear into 2026, well, it's broadening out into many different sectors that didn't get any love whatsoever. Very cyclical sectors that have been beaten down and that institutions didn't really want to buy over the course of the past 2-3 years for the various concerns that I've been talking about over the past 2-3 minutes. Names like consumer staples, right? Companies that don't really have very much pricing power, that have somewhat outdated business models. They haven't done anything in 3 years. Now, since the start of the year, you can clearly see, guys, this is not retail. This is big institutional positioning. You even have consumer cyclicals, which over the past month and a half have been doing really well as people anticipate, both traders and institutional investors anticipate that this might actually be the year where the consumer finally broadens out as inflation comes down, rates come down, and you have a lot of fiscal stimulus policy. Utilities also getting a slight upswing, although not the best, but look at real estate, even some of the REITs finally coming higher. That's because interest rates are coming down. And obviously these companies being mature companies with good dividend yields, they get benchmarked across the risk-free yield. As the short-term risk-free yield, meaning short-term treasury bills, gets priced down in terms of lower yields, well, people kind of flock to other places that have real yields that exceed 4, 5, 6% in terms of a natural dividend yield. And then we talk about energy. And this one is a bit of a mix, right? This one has also been flat for the past 3 years, but now we know that there are heavy energy requirements for data centers. It's just an energy boom, right? A lot of oil boom, liquid natural gas as well, and also renewables, talking about nuclear, which was a big thing back in 2025, but will persist, and even solar as well, right? And battery storage too. So many aspects of the market that have been somewhat dead for the past 2-3 years at this point are now getting the big money rotation. This does not mean that big tech and the AI trade is finished, not at all. It just means that there's now more locations for people to put their money, more locations that make more sense now into 2026 as we start off the year. And that is why you're seeing such a big rotation. Big tech not getting a lot of love, but nothing has fundamentally changed with these companies whatsoever. The AI megatrend is still very real. The money being spent is very real, and the productivity and efficiency gains are very real. It's just that you don't have to seek safety in big tech anymore, because now the picture for the rest of the market is a lot more clear than it has been over the course of the past 2-3 years. So hopefully with this introduction, it allows you to understand a bit better what we've been talking about on the channel for the past 2 weeks, right? There's a lot of money to be made in this market, as I've been saying over the past 2 weeks, guys. But now, right, you can broaden out your horizons a little bit. Even myself personally, we talked about the themes in last Monday's video, not this Monday, the Monday before. I spent like 40 minutes talking about the rotation across various sectors. That rotation has been playing out. Several key themes this year: energy, defense stocks, right? And the second order of things in terms of AI overall, and even value and dividends proving to be a very nice trade. I was building a bit of a dividend position, and I don't really need dividends, right? But when you're talking about cyclical bottoms, potentially, talking about 2, 3, 4 year cyclical bottoms in a lot of dividend-oriented things, such as energy, such as consumer staples, well, now might be the time to not only lock in some nice dividend yields, but it might actually be the time where you finally get some equity appreciation on all these dividend plays as well. So keep all of that in mind as we move through today's video, because I will reference several parts of this introduction as we kind of move along. Speaking about today's video, it was a long intro, but I got more for you guys. Number one, what we'll be doing today, going over a few news headlines. We had producer inflation numbers, retail sales this morning, and a couple other news headlines that I figured should be notable to our analysis. So we'll do that first. Number two, we'll cover some of the bank earnings, more specifically Bank of America. The banks were down today again after posting their earnings, but earnings were very good. The only problem is that a lot of these banks ran super hot the last 8-9 months, and they did miss a few key elements on their earnings, which obviously can be a catalyst to send them to the downside. So we'll take a look at Bank of America earnings, and beyond the numbers, what are they saying about the status of the economy? Because even the banks last year were a little bit timid in terms of giving their guidance from the overall economy. But from what we saw with JP Morgan yesterday and Bank of America and other banks today, they're not so timid anymore on their outlook for the economy, which is also why you probably have a lot of institutions positioning into the rest of the market, aspects of the market that have not done anything over the past few years. After we're done Bank of America and a few other banks, we'll dive into our technical analysis portion of the video where we covered the overall indexes and the infamous rotation, because I'm pretty sure maybe some of you are a bit nervous seeing that big tech is only going down. Is the AI trade over? Is everything done for? Should we be exploring other avenues? Well, the short answer is no, but we'll check on that rotation nevertheless. Then we will dive into our big tech name list right here. As you can see, a disaster for big tech today, but nothing has fundamentally changed. You would expect on a day like today, where there are multiple big tech names down 2+%, that there must be some big piece of news that came out affecting these tech companies today. The short answer is no. there was no news at all whatsoever, just technical rotation. So we'll take a look at some of these names and derive which one of these names or several of these names could be nice opportunities, not only now, but into the rest of 2026. And last but not least, of course, we will cover our biggest losers and gainers of the day. Several names to the downside, several recurring names that have been down and down and down over the past few days as the market rotates. And then the biggest gainers of the day. And you'll see several key themes for 2026 here on the highs, right? And there was a few smoking guns today to let you know that in spite of the large cap tech sell-off, that the market indeed is still risk on. A little bit of a hint, look at the Russell. And also take a look at Bitcoin and crypto. The money is just rotating. It's not leaving the markets, but we'll cover a lot of that when we go through today's video. So today's video should be a very interesting one. Pay attention, watch a couple parts again if you have to. And if you want to skip to any parts in the video, links are always down below in the video description. Let's get into it, shall we? So the SPY down about 0.49, the Q's down 1.07. We talked about the heat map, but just so you guys see it again, large cap tech down again. Software getting beat down again because of the Claude news that we covered yesterday. And then as well, you had the banks down after some earnings from Bank of America, Wells Fargo, and Citigroup. Visa and MasterCard recovering a little bit from their previous declines. Healthcare, very solid day. And the bottom half of the market, definitely where all of your outperformance was had today. One day relative, you can see that even better, right? Big gains in the bottom half of the market. The ones left behind, communication services, that is largely Google and Meta. To the other downside here, technology, and then consumer cyclicals. But keep in mind, that is led by Amazon and Tesla. When you dive a little bit deeper here into the rest of cyclicals, some of the restaurant names, some of the fashion brands, not doing too poorly, as a matter of fact. So that is your market rotation for the day. The market still remains in a greedy territory right now. I know, even after today's decline, but you have to remember, over 60% of the names in the S&P today were actually green, in spite of what you may see across the headline numbers here on the S&P and the QQQs in terms of overall performance. Now, before we get into more charts, let's do a little bit of news coverage right here. So first off, this morning, we got the producer price index for 2 months. We got October, although that's very stale and old right now, came in at 2.9. That was the expectation. The bigger piece of news here was the one for November, coming in at 3% versus the 2.7 expected. That was the same for headline number and for core as well. Nice little piece here is retail sales, though, 0.6% versus 0.4, shows the consumer, in spite of what they may feel or say, they're actually still spending money. And this is not a very recessionary retail sales number, is it? 0.6%, right? In terms of the producer price index, you may be a little bit concerned that it's higher and you might think that the market's reacted to it. No, not that much, as a matter of fact, right? Most of the damage for today started very, very early in this morning, talking about like, 5:15 a.m., right? Here is your producer price inflation numbers. It did not move the market that much. As a matter of fact, we just declined after the open, and it was largely concentrated into these names right here. If inflation was truly a concern, you would see the bottom half of the market, the ones most affected by inflation, they would have been to the downside, but that wasn't the case. See, you have to kind of read between the lines and know what you're looking for. Producer price inflation numbers, as you can see at 3%, we're still nowhere close to the highs of a few years ago, and not even the highs of end of 2024 either. It's just balancing out here. 1 month higher, 1 month lower type of thing, but focus on the Truflation Index, especially for consumers. This should be your go-to measure moving forward, as the PPI and the CPI are somewhat restricted in terms of their outlook, in terms of their scope, right? Moving on to a few other key pieces of news right here. Number one, Supreme Court this morning, there were some rumors that maybe the Supreme Court might announce their decision on the tariffs, whether they were illegal or not. That didn't happen, unfortunately. So they're not issuing the tariff decision just yet. I guess we'll just have to keep watching out for that one, but it's not here yet. Moving on to piece of news number two, hedge funds remain extremely bullish on semiconductor stocks. You'll see that right here, right? Here is your exposure from the hedge funds. As you can see, they've only increased their exposure into the end of the year as well. Some of the highest exposure that they've had definitely over the past 5 years. So although the semiconductor trade appears somewhat muted right now, it's actually not. The big money is still indeed flowing in and staying in. So keep that in mind. As I said, these stocks right now may be down temporarily, but the thesis and the narrative is definitely not over. Still probably hot for years to come. Moving on further here, we got some news from Tesla to end the one-time FSD purchases, shifting to a subscription model instead. So Elon Musk actually posted this morning, subscription model, $99 per month, getting that juicy recurring revenue. Moving on a little bit further here, NBC News reporting that internal US planning has put a price tag of roughly $500 to $700 billion to buy Greenland. This came out early this morning. However, in the afternoon, we did have a meeting between President Trump and, well, the Trump administration overall, and leaders from Denmark, both from Greenland and Denmark. And unfortunately for the Trump administration, well, Denmark is not looking to sell Greenland, right? Nor are they looking to share Greenland so far. The initial discussions were pretty good. It was largely revolving around security and not so much critical minerals. And as a result, they will be working together to see, quote unquote, paraphrasing here, actually, not quote unquote paraphrasing, to see what they can do in terms of improving security, right? In terms of national defense purposes, maybe authorizing the US to go in there with some installations to kind of bump up the security in the region or bump up the measures for national defense in the region. But so far, nothing concrete. This is the first of many meetings to come, so said the Danish PM during that meeting. Moving on a little bit further here, very strong market breadth. The SPY fell 0.5% today, but more than 60% of its stocks were up. Historically, such strong breadth on a down day usually saw SPX rally over the next 1 to 4 days. Here is your outlook on a 1, 2, 3, 4 day basis, 1, 2 weeks, and 1 month later. Overall, just derive the averages. Usually it's positive a large percentage of the time. One of the smoking guns today is that the small cap outperformed large caps for 9 straight days. And today was another indication of that with the Russell higher, the longest streak since 2017. Now, usually in cases like this, you actually saw continuation. Once again, these are your 1, 2, 3, 4 days later, 1 week, 2 weeks, 3 weeks, and a month. Overall, your net averages, let me just move myself over, my bad. Net averages do tend to be quite positive depending on, well, if you look at the overall picture, right, it does tend to be a fairly positive outlook. Now, one thing's for sure, right? If the economy was such a large concern, do you really think that institutions would be such heavily positioned into small caps, but also highly cyclical areas of the market that hinge on a positive outlook for the economy to actually perform well? Probably not. They'd still be stuck in the safe haven trade, which is AI and big tech, right? But no, we're seeing the broadening out. So I too expect the gains on the Russell to possibly continue, especially into this year, as small caps could indeed continue to outperform. Here's another chart that I figured it should be noteworthy to you guys, just to tell you guys about the neat narrative that we're having right now, right? The new era of growth for the US power market. Here you can see several different things in terms of power requirements on the right-hand side for data centers, electric vehicles, building out of further infrastructure, and industrial electrification and onshoring with all the newly established manufacturing. Look at the requirements from 2024 through 2040, right? Massive, massive, massive increase in requirements for the data centers, but also for the reshoring of manufacturing and just the electrification of the overall, well, of many different things, right? People just using more electricity than before. And then here you go. A lot of that is going to have to be from the data centers here, data center requirements for energy, considering a lot of them will be built by the end of this year into 2027 and 2028. Massive amounts of power requirements. So you are still technically early to several segments of the energy trade. So if you think that you're late, you're not late at all. This will probably be a key theme in the markets, at least for the next 2, 3, 4 years, as we really need that power because the grid currently, as it stands, is just not offering enough. Those are your major news headlines. Hopefully you guys enjoyed that. Try to tie it into what's happening to the markets as well today. Now let's spend a little bit of time on Bank of America earnings. Not that much, but we'll spend maybe 10 minutes describing what happened with the banks today and why they were down. So Bank of America down today, almost 4%, just like JP Morgan yesterday, but it's not because they had bad earnings. Matter of fact, the earnings were quite good, and the commentary by Brian Moynihan, the CEO, was also very good. EPS up 2.25% versus the estimates, and revenue beating by 2% as well. So why was the bank down, just like JP Morgan yesterday? Well, they missed on a few key elements, but nothing major, right? Just normal consolidation. You guys know earnings are a casino, and when you can pick apart anything from an earnings report and get us into very natural and needed monthly consolidation, well, the algos are probably going to take that path of least resistance, right? Moving on to the article, Bank of America tops the estimates on better than expected net interest income and equities trading. Let's move into it, shall we? So profit rose 12% from a year earlier. Revenue climbed 7.1% from a year earlier. Definitely not indicative of a recession or bearish outlooks for the banks, is it? Thanks to rising net interest income, you can thank the rate cuts for that, asset management fees and trading revenue. You can thank the market performance for those. With consumers and businesses proving resilient, as well as the regulatory environment and tax and trade policies coming into sharper focus, we expect further economic growth in the year ahead. Curious, that's literally exactly what JP Morgan said yesterday and what we've been saying on the channel for the past month. While any number of risks continue, obviously, we are bullish on the US economy into 2026. Now, you have not heard this from the banks. I will remind you, in all of 2025. What were they saying all of 2025? Well, the consumer appears to be resilient, although there are certain macro risks resulting from the tariffs and geopolitical concerns and all that good stuff. Yeah. All of that is now out of their wording on these most recent earnings call. JP Morgan said that yesterday, Bank of America said that today, and even the two other ones, which we won't cover today, Wells Fargo and Citigroup, largely issuing and echoing the exact same things. Net interest income was up 9.7%, equities trading rose 23%, fixed income trading revenue edged up by 1.5%, which was roughly in line. Fees from investment banking, okay, we're roughly flat from a year ago. We talked about that with JP Morgan. That was JP Morgan's miss yesterday as well, and Bank of America's miss today. Now, that's because they had very tough comparable numbers. Q3 and Q4 were extremely bullish investment banking metrics from the banks, right? And now you have very tough comparables. So if we're looking for the next names that might drop in spite of probably posting good numbers in absolute form, if we're looking at Morgan Stanley and Goldman Sachs into their respective earnings, they'll probably have good earnings, right? But if their investment banking fees come in somewhat flat or marginally higher than sequentially Q3 and Q4, right? Like if investment banking was up, I don't know, like 15% every quarter, Q3 and Q4, and then they post 11 or 12%, which is great in terms of an absolute number. Well, when you're this far extended from the moving averages, what do you think is going to happen? Well, they're probably going to go down, right? So you can kind of see it coming. If it does happen, don't ask yourself why. So that being said, that's pretty much it for your Bank of America rundown right here in terms of the highlights from the article. You take a look at some of their other metrics, right? I mean, they beat pretty much across the board. There's nothing soft here in terms of misses, right? And even the commentary by the bank, take a screenshot. We're not going to go through each and every one of these overall. Obviously, they provided some fiscal year net interest income growth, about 5 to 7%, which is very solid, guys. Very solid net interest income growth, which is the most looked at formula for pricing out any bank in terms of their forward growth. Consumer banking segments were very good, up 5% per year. Global wealth and investment management, that was up 10. Global banking, 2. Global markets, up 10% in terms of trading revenues and whatnot, right? So very decent numbers. Very hard to pick apart Bank of America's earnings and say, well, they deserve to be down 4%, just like JP Morgan's earnings yesterday, right? They don't deserve it, but, you know, things weren't as picture perfect, and we know, and if it's not picture perfect earnings and these companies are up a ton, well, they will just go down, even if they do have good earnings as part of natural consolidation, right? Moving on into some other metrics that are very key to our analysis for some of the banks, you always want to look at the net charge-off rates and the provisions for credit losses. If they are increasing provision for credit losses in a large fashion, you might assume that they're nervous about the status of a consumer or businesses or both. That's not happening, right? 1.3 is your current provision for credit losses, $1.3 billion, right? That is down from the fourth quarter of 2024 a year ago, 1.5, and the same as the third quarter last time, right? Net charge-offs are all absolutely down from last quarter, 1.3 billion versus 1.4, and that is also down from a year ago, Q4 of 2024. So please keep that in mind. If we're looking for more details here, I mean, you can kind of skim through these and see, you know, total assets under management are up. Consumer banking is not too bad. Global banking is not too bad. This is true, right? Their loan balances are up as well. But what really we got to focus on, right, is not so much that. When we look at the banks, we want to know about the health of the consumer, yeah? Because that's what matters the most in terms of this economy, because those are the themes for this year, right? Jobs, market, health of the consumer, K-shaped economy, et cetera, et cetera, et cetera. Net charge-offs as a percentage, okay, 0.44. That is a lot lower than last year and a lot lower than just 2 quarters ago. So charge-offs are not the issue right here. Provision for credit losses, as you can see, that's a downtick from 2 quarters ago, roughly in line with the third quarter of 2025. And your net charge-off ratio for credit cards, 3.46%. Or actually, sorry, 3.4. Last quarter was 3.46. This too is roughly in line with what JP Morgan said yesterday. Very low net charge-off rate. So once again, right, the banks are very well capitalized. We didn't cover their capital ratios, but CET1 right here, 12.8, and the SLR 5.7. No problems with capitalization and no problems in terms of the consumer. And management says they're very bullish heading into 2026. So keep all of that in mind when we're thinking about the banks. I mean, we can go over a few more, right? We're not going to cover these, but just to show you guys that it's more of the same, right? If you take a look at Citigroup right here, Citigroup was down, as you guys can see, right? 3.34%. But where have they gone over the past 9 months? Straight line higher. So of course, any slight misses on revenue, well, the algos are going to take advantage of that and kind of reduce the price and go into natural weekly, because it's been 7 weeks of up, 9 months of up. And they're going to go into natural consolidation. That's for Citigroup. That's for Wells Fargo, right? Is it justifiable? Well, yeah, they missed on a few key metrics, right? Slight miss on adjusted revenue, slight miss on sales and trading for equity overall. Good everywhere else, right? Personal banking, that was a slight miss here on wealth management as well. But there's nothing. This is Citigroup, right? There's really nothing massive to report. Everything was pretty good. Net interest income as well, right? Here you go, 5-6% growth year over year. That's very good for a bank. And return on total capital employed, 10-11%. I mean, that's a little bit less than JP Morgan and Bank of America, but still very strong. So do they deserve to be down 4? No. Arguably, if they hadn't had a 9-month plus rally, right, and super extended, would they be up today? Probably, right? But today, unfortunately, they're down. It's just how it works. Moving on to Wells Fargo right now. Do they deserve to be down 4%? Well, arguably not, right? This is Wells Fargo's chart right here, 4.61%, big gap down after earnings. Did they deserve to be down? Well, I don't know. They've been up for the last 6-7 weeks in a row. You got to consolidate eventually. And these numbers were just not crazy, right? Slight miss on revenue despite being up, slight miss on EPS, slight miss on net interest income. That's enough. Fiscal guide, 50 billion versus 52.7 for the year. There you go. That's low, right? But loans, mid-single digits growth. Deposits, mid-single digit growth. Consumer banking, right? 7%. Commercial, a little bit flat. And then wealth management, up 10%. So there's nothing really bad here. You know what I mean? Like there's some notable items here, but for Wells Fargo specifically, it has to do with several write-downs overall, but decent return on equity, decent return on total capital employed. Liquidity ratios are very solid at 10.6%. And here you go. Here's the commentary. Strong financial performance. Then you also have the achievement of their return on total capital employed ratios. And just commenting on the fact that the Fed lifted a few caps, right? Which was the case about 2 quarters ago at this point, to let the banks kind of loan out more and not have as much liquidity because they saw that the economy was in a brighter spot. So the Fed allowed them to loan out a bit more. But even if you look at the earnings calls, I mean, none of these CEOs from the banks are bearish on the economy, right? So overall, to sum up the initial bank earnings, the bank earnings were very good. If you only look at the performance of the banks, such as JP Morgan and Bank of America and Wells Fargo and Citigroup, you might think there's a problem. There's no problem at all, just very healthy consolidation. Now, my favorite 2 banks out of the bunch, if I'm looking to invest, is probably JP Morgan, as we said yesterday, 300 down to about 280 is the slight little sweet spot pocket that I've been talking about, 12 EMA. And then Bank of America is probably option number 2 for me. And for me, that would be a buy probably under 50 bucks. Let's call it 50, down about 48. This little pocket of the 12 down into previous support right there. Give me a nice little consolidation. Maybe I'll contemplate some swing trades or some buys, or if you're looking for the banks in the long term, maybe those are some areas that you could consider as well. But right now, all 3 banks or all 4 banks have said the same thing as well. They've all also said that a 10% cap on credit card interest rates wouldn't be too good for the consumer. And wouldn't be too good for the overall economy because it's going to restrict a lot of people, right? Brian Moynihan was on CNBC this morning, and he was asked, what would be the minimum credit rating if banks were to cap interest rates at 10%? What would be the minimum credit rating so that somebody would be approved to have a credit card? He said 700. I know a lot of you guys are on top of your stuff, right? You guys probably have over 700 credit scores, but the average person does not have above 700, right? So it will limit access to credit overall, which will kind of, as he was saying, which will kind of push people into different lending plans, such as either buy now, pay later, or dubious personal loans, also at the between 10 and 15% interest rate. So it's like, you're not really going to solve much. People are just going to go to other sources of credit necessarily, possibly with lenders that may not be as well capitalized as the banks to deal with any delinquencies and any defaults, right? So that's the summary for your banking earnings overall. Good earnings, bad price action, but good earnings and very good commentary for the status of the economy into 2026. And that kind of sums it up overall. Now that that's out of the way, we covered the news, we covered the rotation. Let's get into some charts. So the S&P 500 down 0.5% on the day. It was a lot worse midway through the day, but nice little end of day recovery there. But obviously, the key element here is the equal weighted SPY. Look at this outperformance from the equal weighted SPY, something that hadn't done much of anything over the past year as big tech was the place to be. But now that big tech is still the place to be, but that you can broaden your horizons a little bit, right? Well, you have the broadening out of the market, but big tech is such a heavy weight and the banks being down too didn't help. That being said, did we lose any major levels? No, the bulls are still in full control, right? Still a daily uptrend looking for a higher low. Anything above 680, still a daily higher low attempt by the bulls right here. 50-day EMA and support is 683 down to 679. That is your little pocket. Can't lose this. If you lose this, then we can get a little bit worried about possible further weekly consolidation. But as of right now, this is just a very healthy pullback in a broadening out market. I will reference the breadth of the market again. Doesn't definitely seem like the market is doing poorly, right? 65% of all stocks above their 20-day EMAs, 68% of all stocks above their 50-day EMA. This is the closely watched institutional average, which lets them know when to put the foot on the gas and when to take their foot off the gas, right? This is a much, I mean, we're at the same, I referenced this a few times in the past, right? We are at the same level, identical, than the highs in October. But notice the difference here, okay? Where were we in terms of this percentage of stocks above their 20-day moving average at those highs in October? We were here, terrible market breadth. Now, much better. Where were we on the percentage of stocks above their 50-day EMA? We were down here, terrible market breadth, some of the lowest market breadth that you will ever possibly see, right? We were down there in the danger zone. Now, very bullish. Percentage of stocks above their 200-day EMA, same concept. Where were we in the end of October? Well, that was here. It wasn't that much far off. We had a nice sell-off in the markets overall, but not many companies losing their 200-day EMA. That's not very easy to do, right? Now, better than arguably we were for most of 2025. You're going back into 2024 end of year breadth right there, right? So very solid market breadth expansion, which is why, even though tech was selling off today, should you be nervous? Probably not. The money is not leaving the market. It's just rotating. But I know several of the easiest plays of the last few years haven't showed up in 2026 so far, right? We've talked about this so far. I mean, you can think of big tech. Big tech has been nowhere to be seen. I mean, shout out to Google. At least Google's at the all-time highs. But a lot of big tech guys has been nowhere to be found over the course of the past quarter. There's been some ups, there's been some downs, but largely no big trends, at least not to the same effect that you were used to in 2024 and 2025. But even some of the fan favorite retail names that were quote unquote easy money last year, like just go long Palantir at any price and you will win. That hasn't been popular since August, right? SOFI, go long at any price. So many other YouTubers only make videos on 4 names: NVIDIA, SOFI, Palantir, and Robinhood. All right, great. NVIDIA, nothing. SOFI, nothing. Palantir, nothing. And Robinhood, nothing. And we kept saying it on these names, right? It's not going to be as easy to make the gains. Some people bought these stocks either down here or here after tariffs, right? You will not make the same gains with as much velocity into the future as people who bought down there. So now people find it challenging because now you actually have to do a little bit of research to get your alpha, right? You have to look into some sectors that you may not be interested in, right? Like some may be cyclical industries, such as basic materials, right? Nobody really follows that, such as some utilities plays in relation to the data centers, right? Some different energy plays overall, such as either oil or natural gas or renewables like nuclear or solar, things like that. Some industrial plays, right? Some of the defense corporations. You got to kind of be well versed on drones and what the government is spending their money on, because a lot of these defense companies, I mean, let's be honest, they've been some of the best performers of the S&P 500 year to date. If you just take a look at these right here, you'll see, right? Sure, there's some memory plays like SanDisk and other things, but look, you got Moderna up here, some healthcare names, Albemarle, right? Not all people look at that. Huntington Ingalls, they build ships. for military purposes as well, right? They're up 23%. Schlumberger, right? Also energy play, middleman essentially, right? 23.5%. BLDR, some of the real estate plays coming back in a big way. Like, where's big tech? Where are all the fan favorite names? They're nowhere on this list, are they? Right? It is changing. You have some recurring players from last year, like SanDisk and otherwise, right? But you're seeing a lot of breadth, right? What do we have here? You have defense corporations, you have memory players. Memory, you got to be a bit more well-versed than just buying NVIDIA or AMD, right? You got some energy corporations here. You got some healthcare players up here. You got some chemicals. This one was destroyed. Like, look at Dow. Dow's already up 20%. They were at multi-year lows, right? It's much easier to send something up 20% from multi-year lows than it is to send NVIDIA up when it's a $4 trillion market cap, isn't it? Or to send Palantir up 20% when it's a $400+ million market cap, right? And the market's broadening out. I'm not saying that these other names, the popular names from last year, won't do well this year. I'm just saying they may not do as well as some other names that are at multi-year lows that can rally really easily off the bottoms, right? I'll give you an example. Like, look at the dollar stores. You know what I mean? From those lows in October, okay, the dollar stores are up like 65%. Now, we know it's not much in comparison to some other tech names or some small cap names like OSS, right? Obviously not, but it's a dollar store. You know what I mean? It's easier to bring these from here to there, you know what I mean, than it is to bring back the money into Microsoft and make Microsoft rally 65%, right? Makes perfect sense. So the money is just moving elsewhere because the risk-adjusted returns may be better elsewhere now as well. But I'm still very bullish on big tech and AI for this year. It's just you don't have to exclusively be in there to make money this year. So hopefully I'm clear on that, right? These are still some of my largest positions, but I have been broadening out my horizons as well. On the Qs right now, same concept, right? Daily. I mean, the Qs is just very simple, right? It was a tightening wedge. They tried to break out. They almost came back within right here. I say tightening wedge because of this, right? They try to come back inside of it today. We'll see what happens, obviously, but no loss of the trends right now. Still a daily uptrend. Higher lows are planted down here, 610 in a support as well, 612 and a 605. The weekly, still a tightening range as big tech is nowhere to be found, unfortunately for them. And the monthly is still in full bull control as well. So the bulls haven't lost anything. They're just, I assume, biding their time and the money's rotating elsewhere. Big tech is probably going to have phenomenal earnings this entire year. There's no secret there, right? And a lot of these big tech names are down significantly off their highs. So I am buying some of the big tech names, but at the same time, I'm also diversifying into different aspects of the market, right? If you guys want a breakdown of kind of what I'm doing, what I've been sharing with the Discord, right? I'm as follows, yeah? I'm 15% into the Trump themes, okay? Which are going to be, well, 15% into the Trump themes, but I'm playing them with, gotta make this a bit smaller, yeah? 15% of the Trump themes, which are, you know, defense and energy and infrastructure and industrials, obviously, but I'm playing those with small caps and mid caps, okay? So $1 to $10 billion range, because I want some lift on these, right? I don't want to just sit in these for nothing. No, I want to get some big lift, big percentage gains. Then 70%, I'm still buying the dips and I'm still exposed to big tech. And then the other 15%, I'm actually building out value in cyclicals. That could be anything from REITs or dividend plays or consumer staples, things like that, right? So that is my barbell approach to this year. I'm playing the key themes with 15%. I'm playing the recovery of value in cyclicals because you may not find some of these prices on value in cyclicals anymore, especially if we're about to broaden out the entire market for the next few years for economic growth. But I'm still 70% in big tech and I'm buying these dips and I think they'll do very well. But at least I am devoting certain segments of the portfolio to play it a little bit differently, right? Usually I share that information with the Discord, but there you guys go. I'll do it on the YouTube channel today, and that might be the last time you see it overall. I'll still cover things in a broad fashion, of course, but that is pretty much where we stand. Financials, unwinding the daily uptrend, of course, as well, right? So daily uptrend, unwinding the daily uptrend, in a support right now, 54.5 down to 53.5 overall. Big level, previous resistance, current support, and still just looking for a nice weekly higher low. So no red flags on financials overall, just natural consolidation. Monthly as well, maybe going to a bit of consolidation, but nobody losing any trends here. Still, my favorite plays, I'll say it once, I'll say it 1,000 times, Visa and MasterCard. I think the sell-off is way overdone. And some of the banks on back tests, right? JP Morgan at the monthly 12 EMA, Bank of America maybe back testing the 12 EMA, right? If they offer them, I might take them, but for now, I'm largely playing Visa and MasterCard in a bit of an accumulation phase. Moving on to healthcare. Let me just close some tabs. I don't want everything to slow down, so sorry about that. I'll kind of take you guys through this. My bad. Maybe I should pause the video, but hey, at least you guys know I just filmed this stuff straight through, right? Moving on to healthcare. Healthcare, decent little daily uptrend. Uptrend continues, bouncing off the support 156 and trying to go for a little bit more. It's healthcare right now. Very solid. Probably another popular theme into 2026. Healthcare, because why? Healthcare didn't do anything in the past 3 years. Now they're looking for the final leg of expansion, right? This has been pharmaceuticals, medical devices, but the one area that is still somewhat choppy are the CNCs of the world, the Molina Health of the world, the UNHs of the world, right? Insurance plays a little bit choppy because the ACA subsidies are still kind of up in the air, and President Trump might want to redo, quote unquote, the Obamacare policies, right? So that one still might just be a little bit cloudy, but pharmaceuticals, shout out to them, man. Pharmaceuticals, medical equipment, devices, very popular trades right now. Moving on to semiconductors right now. Semiconductors down 0.81, but no trend has been lost whatsoever, right? Daily higher lows are planted right here at about 375. Even if you lose that, guys, right, into a daily downtrend, is it that big of a deal? No. Weekly, still very healthy. Looking for a higher low there, too. Anything above 340, higher low. Possibly backtesting prior all-time high resistance and the curling up of the weekly 12 EMA. So keep that in mind. Few key players right now. My favorite 3 names in semiconductors right now, probably Marvell, NVIDIA, and AMD, just because they're consolidating and they still have very advantageous valuations. I'm not chasing the LRCXs of the world or the ASMLs of the world. There was a time to build those, and we did describe the time to build those. I'm not necessarily chasing Micron. If we're already positioned, fine, but I'm not going to buy it up here, nor am I buying the other memory names, even though I know there's a memory shortage. It's plastered literally everywhere. If you don't know, I don't know where you've been, but there's a massive memory shortage. You know, it's just the risk to reward. I'm looking for good risk to reward, and I do still think there's some nice risk to reward in NVIDIA, AMD, and especially a name like Marvell overall, so keep that in mind. Those are just my plays. You guys are free to do what you want. Small caps here. The Russell booming, right? Very solid play. And that's the smoking gun. There's a few smoking guns today. Number 1 was the equal weighted SPY to give you an indication the markets were healthy. Number 2 is the Russell to give you an indication that the risk on trade is still there, but you got to look a little bit deeper this time, right? You can't just focus on SoFi, Palantir, and Robinhood and ask yourself, well, why are they not up? But there's a ton of other names that are up, right? We'll just, get a sense of the themes that were up today, right? Look, critical minerals, space, defense, AVAV, crypto was up a little bit too. Some medical names like Tempest AI, right? And more energy, right? SMR, Intel, which is a direct government investment as well. And then some consumer retail names and some oil stocks. All the themes that we've been talking about. Look, Lockheed Martin, right? So several of these names, like they shouldn't surprise you. Raytheon. You know, you got some consumer staples here as well, such as John Deere. Look, Oxy. You know what I mean? So, and then you have a bunch of names, dividend names, Altria, the dollar stores, Verizon, Canadian Pacific, right? Just value, and then key themes, right? The president was telling you what to trade. We covered it last Monday as well, but you know, growth is definitely there, but it's growth, especially small caps, that you need to know what to look out for. So focus on the key themes, right? That being said, Russell looking really nice. Tons of space for a curl down if ever they get tired. Anything above 246 looking for a higher low for possible further trend continuation. And on the weekly timeframes, beautiful weekly expansion. Tons of space here for the same thing if we need to consolidate a little bit. And the monthly is gone right now. Nice expansion. I'm not playing the Russell directly. I am choosing to play key individual names, right? Smaller cap, robotics and drones and military things, stuff like that. Small to mid caps, $1 to $10 billion range. I'm a big fan of as well. If you guys don't want to do that, you can always play the defense ETFs themselves, right? Maybe it gives you a bit better breadth, right? In terms of just being positioned into a lot of larger cap things, like ITA is a nice aerospace and defense ETF. You might think it's ran a ton, and it has, but it probably has a lot more. So buying off any consolidation could be interesting, or if you want to focus on the small and mid caps, we've brought up a few of them over the course of, there's a few of them, right? I'll just lay out a few of them. There's, Redwire. There's OSS, everybody's been talking about recently, right? There's Ondas, although Ondas does need a little bit of a pullback to get me interested again. There's names like Kraken. I'm just giving you guys the more popular ones, et cetera, et cetera, et cetera. You guys can look into the other ones on your own time, but those are just a few ones that I'm kind of focused on overall. There are more, but I'll just give you guys 4 or 5 at a time. And then, we're not going to talk about the rest because we did a good job talking about these throughout the earlier portion of the video, and on Monday, when we went through the broadening out of the market, through XLP, right? Through consumer retail, through utilities, especially independent power producers, in line with data centers, right? Talking about the Vistras of the world, the Duke Energies of the world, right? The Dominion Energies of the world, but also the CCJs for uranium plays, the Constellation Energies as well, right? There's tons and tons and tons of plays, either utilities or direct energy players that we can possibly be exploring. Real estate, we talked about this many times, home builders, mortgage companies, and even potentially REITs as well, right? Oops, I don't know why I typed it in like that, but the REITs as well, right? XLRE is largely full of REITs, but even like my REIT that I own in my portfolio is Vici, the landlord for Las Vegas, right? Multi-year lows, phenomenal dividend yield, 6.45% overall. When you reduce interest rates, usually these REITs tend to catch a little bit of a bid, and you can see they're kind of starting to curl a little bit here, right? It's a slow trade, but you're picking this one up at multi-year lows at very attractive dividend yields, whether you're an ETF or an individual name, and then energy, right? This one, XLE, is just a bunch of oil companies and natural gas companies, but pay attention. There are many, many, many phenomenal either oil plays. If you want to play this as an ETF, this is like what, 2 years of negative momentum on the MACD. What just happened? MACD cross, first time in 3 years. So it looks like they're going for something, right? Whether you want to play the big oil companies or midstream pipelines or the refineries or renewable energy, such as through an ETF like NUKZ, which is a lot of nuclear names as well, or solar, right? Up to you. I've given a lot of ideas on the channel so far. I'll try to give as many as possible on a daily basis, but, you know, there's many themes, many, many, many themes, and you don't have to look too far. I'm even giving you guys ETF. So whenever I give you an ETF, what you should be doing on your end is go into this ETF, get the holdings list, look at the holdings, and then see if there's any plays that you actually like, right? So I'll do a lot of the work for you guys, but you also have to put in, I'll put in 80% for you guys, but if you guys can put in 20, you'll find the alpha, you know what I mean? Moving on, or just join us. I hate shilling like this, but you can always join us in the Discord because we talk about this stuff every single day, right? The VIX moving a little bit higher today, but no news whatsoever. No news. I mean, there was the Greenland stuff. Obviously, there is the turmoil in Iran, of course, which we haven't talked about so far on the channel, but that also added a bit of fuel to the fire today. But no big tech news whatsoever. Further bank sell-offs. I mean, the VIX was kind of on a pump today, but it's kind of fake news, right? Nothing macro broke, nothing bad in terms of big tech broke, just a bit of a volatility expansion day. For no specific one reason, but just a multitude of little factors per sector here and there. Further tech sell-offs, earnings from the banks, which were good, but then the price action sold off. You had the debate surrounding Greenland. You had the further turmoil in Iran, obviously, which led to higher oil prices throughout the day before they had a big correction intraday. So there are many little factors to the VIX, but nothing big broke. And nothing bad was reported in the macro data overall. So that's your overall market outlook. Hopefully you guys enjoyed that. Into the metals right now. Metals is running super hot right now. Gold, anything above 44.17, just looking for a new daily higher low. We'll cover these quickly. Obviously, next targets are psychological 47, 48, then 5,000, of course, right? We skipped 49, but you guys get what I mean, right? $100 increments. Weekly still in control, although still weekly overbought. And this is further bearish divergence right there. So just be careful on gold and silver, very extended right now. Gold, I mean, look at the monthly MACD, right? It's 94. When's the last time it hit 94? The 1970s, probably, right? Super, super extended move. So the risk reward is probably not here, but I get it. If you're still in, at least do yourself a favor and trade with a trailing stop. Silver, same concept, right? Further pushes on silver, almost $100, man. 93 on silver right now. Phenomenal push right there on the daily. Anything above 74, just looking for higher low consolidation. And same concept, right? Do yourself a favor if you're in these and trading these. Don't round trip your gains. Lock in the profits as you move higher, right? The incremental risk to reward is getting worse and worse as we push higher and higher through the levels. Daily overbought conditions again, weekly overbought conditions too. This is additionally is bearish divergence, right? Peak there on the RSI. You won't get to 91 unless this literally flies to like $120 by next week. You know what I mean? You're not going to get a higher RSI than this. It'll be bearish divergence for the foreseeable future. And a 93, 94 on the monthly RSI. So decent time to take profits. I get it. It's super popular, but trade with a stop loss. You don't want to round trip anything. And, you know, a lot of gains is better than round tripping some gains, of course. And then pay attention, guys. Pay attention to copper, please. Pay very close attention to copper. I'm not saying playing copper as is, but pay very close attention to copper miners or anything associated with copper, because the demands for copper are going to be substantial over the next few years, especially because of all this AI build out. And although some people are talking about it, not many people are talking about it, but that'll probably be a very hot trade into the next few years as well. Moving on to crypto, the other smoking gun for today, right? Bitcoin, second day of expansion right now, right? Daily uptrend is very nice right now, creating a lot of space. Overhead resistance, 100 up to about 105, 106. Daily higher lows are here, 89.5. Any move lower, higher low, going for more trend continuation. Very nice expansion move on Bitcoin right now. If they can close the weekly above here, 95. First weekly uptrend, you got a shift in the MACD. You can tell it's getting more and more bullish as we move through time, but once again, resistance up here. So finally, you got the daily uptrend. You're looking like you want to consolidate this into a weekly uptrend. And as a result, if they close that way, the monthly lows are probably set. And now you're probably going for a bit of monthly expansion. I don't know, because this is a very deep retracement, right? I don't know if they have the juice to do the full V-shape and all-time highs. They may have to two-step this one, because usually when you get such deep retracements, guys, it's very tough. It needs a lot of money in a straight line to pure V-shape, right? I'm not saying it's impossible. I'm just saying it's not the most likely scenario. A more likely scenario is the monthly two-phase monthly uptrend recapture to build momentum as you kind of clear the levels to the upside. Still a decent location for Bitcoin for the long term. We've been saying that since the mid 80s. Ethereum is the exact same concept, right? Ethereum looking good, daily uptrend, a lot of space above the higher lows, which is about 3,000. Any move lower, higher lows, going for a bit more. Weekly time frame, you need a bit more. Need to close above 34.50 for the weekly uptrend to be actually in motion, and that's pretty good because it's been like 4 or 5 months of sell-off, 4 or 5 months of very soft weekly MACD, finally starting to curl over, and on the monthly, finally starting to get some activity as well. This was also a fairly deep retracement, so I don't know if they have the juice to go for the full V-shape or if they have to two-step this. The probable scenario is the two-step, but next area of resistance, 4,000 up to about 3,700. So it's been a nice area to accumulate Ethereum for the short term, or I mean for the long term down here, right? And still is, but as you kind of move through the levels, well, the risk reward gets a little bit worse. So I'm not saying FOMO and like now's the time to buy, but you should have probably been buying. Still the time for small accumulation, but the buys should arguably have been bigger here. And now you're just kind of loading up the last few dollars that you wanted to carry maybe for the expansion. But so far it looks good. I guess we'll see what has to happen over the next few weeks overall. That's everything for your overall market rundown. Now let's dive into the problem children of the market, big tech. Okay, so before we get into big tech, I just want to preface this with a little bit of a statement, right? Something that'll make your life a whole lot easier when looking at these big tech companies and wondering whether you should be buying the dips on some of your favorite companies. Obviously, Apple's down a ton from the all-time highs. So, well, Amazon is not down a ton from the all-time highs, but Amazon hasn't really done much for the past, like, let's say, year overall, right? But even Google is the outlier right now. So I guess the focus will be on Apple, AMD, which is down a ton, Amazon, which hasn't done anything, Meta, which is down a ton from the all-time highs and dropping more today, Microsoft, Netflix, NVIDIA, Tesla, right? I'll just ask you guys a question, yeah? And I assume you can even extend this into the Palantirs of the world and whatnot, although that one has a very high valuation, right? The Broadcoms of the world, right? All of this stuff, for the most part, okay? For the most part. Now, I'll ask you guys a question, and you guys should always ask yourself this question too. Since October, when a lot of these big tech names peaked and started dropping, right? Has anything changed with the fundamental thesis of these businesses? Have they lost their moats? Have they lost their profit margins? Have they lost their international exposure? Well, the quick answer is no, right? So when nothing changes about the thesis or the themes at play, the AI theme is definitely not going away anytime soon, right? When the only thing that it's changed with your company, your favorite companies, is the price. Do you guys think that if the thesis is intact, the moats are intact, everything else is intact, do you think that you should be buying or selling? You should probably be buying, right? I'm not saying buying super heavy, but you should probably be using these dips as good buying opportunities because although the price action may be confusing and the rotation may be confusing if you're new to the markets or whatnot, I'm just here to shed some light into why they're dropping and what we can possibly do, right? So keeping that in mind, moving into Apple first, right? So Apple, daily downtrend, a little bit soft here, but Apple has been daily oversold conditions. Usually that does result in a bit of a bounce. We've been getting a bit of a bounce, but it's been a soft bounce, right? Bit of a bounce, but keep in mind, big tech has just been abysmal recently. So the bounce is not that hot, but if we do bounce a bit more, 265 up to 275 is your big resistance range above. I mean, I guess I'll put this box red just so you guys understand it is indeed resistance above. And the green box is to be buying, and the red boxes are to be selling for any swing trade purposes, right? So daily oversold conditions, weekly, lost the weekly uptrend. This is going to take a while to get back. And monthly, just monthly consolidation. I was saying that up here. I was saying Apple's not a buy up here. I'll be a big fan of waiting for the good old breakout retest of where the 12 EMA and previous all-time high resistance. We're about to get that soon. Okay, and Apple should be having a good Q4. So although before I wasn't a fan of buying Apple up here, 250, 240, that's where I actually get interested. And the valuations make a little bit more sense. I'm not saying Apple is cheap, not by any measure, but at least at 240, it makes sense to look at this one for swing trades, as if it does approach there, right? Well, then there'll be 15% off the highs. And usually when you do find Apple 15% off the highs, it can be a nice buying opportunity. Moving on to AMD. AMD has been having some good days as of late, but let's be honest, in the past month and a half, 2 months since November, they haven't done anything, right, in terms of price action. But what have they been doing? Well, they've been delivering excessively strong guidance, and the thesis is still largely intact. Huge EPS growth, huge revenue growth. So while AMD consolidates down here, should we be panicking and selling and saying, oh no, the run is over? Probably not. They're just embarking into their massive growth phase overall. So keep that in mind. Although the daily price action is slightly confusing, no trends, right? Got to get the daily uptrend back. Then you got to get the weekly uptrend back by cracking these highs, right? High, higher low, higher high, et cetera, et cetera. You're just in monthly consolidation. You can clearly see that if you just zoom out. When in doubt, always zoom out, guys, right? Monthly higher lows are being set. AMD, we've said it a few times. Every time it comes down there, I'm selling put options down here to farm some premium, or just buying a few more shares if we wanted a bit more exposure, because AMD has much more to go, in my opinion, around 200 or 220, 10% higher. You're trading relatively cheap on a PEG ratio basis and a price to sales basis, at least in relation to the massive growth, and they will be expanding margins too. Amazon down 2.45%. Why? No reason whatsoever, just big tech consolidation, right? Beautiful daily uptrend, backtesting support right now, 240 down about 230 is the area. And if they give all this move back again, you guys know what to do, right? Zoom out. Where are we? Monthly uptrend accumulation range. They've been doing this for 5-6 months. Great opportunities to be selling some short puts, low 230s into mid 220s for farming some premium. Decent location to be accumulating some shares. Why? Because we have the guidance. They will probably have a very solid 2026 expansion of revenue, expansion of EPS across all their different segments. And the valuation here, at least around 235, is very fair. You're trading a 1.5 peg for Amazon, and Amazon's going to be delivering some pretty substantial numbers over the next 2 years in terms of margin expansion, free cash flow expansion as well. Moving on to Google right now. Google, the outlier, that's definitely for sure, right? Daily uptrend is very healthy right now. Google can kind of do no wrong in this market, but it doesn't necessarily mean that it's a buy, right? Buys up here are challenging. Why? Although we do have a nice daily uptrend with tons of space, anything above 310, looking for a higher low, maybe for a bit more. I mean, your daily overbought, your weekly overbought conditions as well, your monthly overbought conditions, and the valuation at 330 is at the top end of the range. Google usually trades from about a 20 at the lows in terms of multiples down here, and then as high as 30 forward price to earnings, right? And it's trading around a 2 peg. So Google, it's nice to still be in, but if we're trading, this is arguably a take profit location because the risk to reward starts to not make sense up here. Am I selling any of my long-term shares? No, I've been very clear about that. I still love Google, but I'm not adding anything more up here, nor for swing trades, nor for long-term shares. I think that's a little bit greedy. Moving on to Meta right now. Meta is definitely not greedy down here. Breaking down, loss of support. We talked about this yesterday. 640 down about 630. They lost it. Daily downtrend, and now unfortunately the weekly as well. After trying, making an attempt here, weekly back into a downtrend, and monthly back into consolidation. You got to pay attention down here. 578 is your monthly lows, right? This has been a nice monthly uptrend for the last 3 years. If you get a crack of this, that's a monthly downtrend, and then it just takes a while to recover. The reason being, Zuckerberg is still not clear on what they're, well, he's been more clear in the last 2 days, reallocating money from Reality Labs towards cloud. Now Meta's finally going to be doing cloud, but that takes a while to make that pivot, right? So Meta down here, especially down here, low 600s into high 500s, extremely attractive location. It's trading at a very cheap multiple right now, low 20 forward PE, 1.63 peg, very decent area to be building a position on Meta. If you don't have this company or if you wanted to add to this company, very solid. So although the short-term price action sucks, you're almost back in a daily oversold condition into a huge support range at a very decent multiple. So now will be the time to go shopping if you're interested in Meta. On to Microsoft right now. Same concept on Microsoft. They've been trapped here doing nothing. And we were saying, it kind of looks like a bear flag, right? Loss of this big level, back testing it, unable to get through 490 to 500. And now with the day like today, they finally broke down, right? So daily downtrend on Microsoft, almost daily oversold conditions. How often does that happen? Well, the answer is not very often at all. And every time it does happen, it tends to be some form of a local bottom here, right? This was the tariff lows back here, right? It tends to be an area where the bulls find a little bit of momentum overall back here, August 2024, right? With the Japanese carry trade unwind. So Microsoft does not hit daily oversold conditions that often. Whenever it does, it can be a nice buying opportunity. It won't solve the short-term price action. Like, you're not expecting this, right? But you're expecting a bottoming out zone. And when you can couple that with other areas of confluence, such as huge prior resistance, 459 to 430, which is current support. We've been talking about this area, guys, between the 12 and the 26 monthly EMAs. Nice monthly consolidation. Microsoft is now down from their highs 17%. What has changed on Microsoft from these highs? The answer is absolutely nothing. The market is just rotating into different things right now. But whenever we could find Microsoft between the 12 and 26 on the monthlies, just look at historical precedents, right? Here, 2022 bear market here, 2020 COVID here, 2018 tariffs here. It doesn't happen too often, right? Okay. You can couple that with big support and daily result conditions, all things that happen very rarely. While the thesis is unchanged and the fundamentals are still solid, and the valuation makes sense as well, well, then you end up with a very nice buying opportunity on such a high quality company. Okay, so keep that in mind. Moving on to Netflix right now. Netflix down 2% today. You know what's funny is they were actually up 1% this morning, and then they gave it all back at the open when big tech just got absolutely destroyed. So unfortunately for Netflix, another day of downside. This one has earnings next Tuesday, so the price action until then will probably be muted. Lower support range stays put down here, 86 down to 82. Netflix is now down from their highs 35%. What has changed? Nothing. Last earnings, why did they come down? A tax hit from Brazil. Does that sound like something that changes the business model? No. What has changed since here? Well, the entire Paramount Warner Brothers Discovery noise, right? That doesn't change the business model long term. It's still a company that generates very consistent margins, very consistent free cash flow, very consistent EPS, and very consistent revenue growth. But I know some of you guys just don't want to play it until the noise is beyond us. That's perfectly normal. But if you enjoy Netflix and you want to build a position for your long-term portfolio, well, now is not a bad time. Under 90, you're trading at a 1.4 peg with very decent revenue and EPS growth, good subscriber growth as well, decent profit margins. So this is an attractive area for Netflix, but we'll see what they have to say for earnings, daily oversold conditions, been a while now, and weekly oversold conditions as well. That does not happen too often. On to NVIDIA right now. NVIDIA down 1.5% overall. Same concept. What did NVIDIA do today? Absolutely nothing. Well, they did nothing in terms of price action, but they didn't do anything wrong, right? Daily, slight daily downtrend here. The weekly, just looking to, I'll zoom in so it's a bit more clear, right? The weekly, what are we looking to do right here? Well, they're trying to make an attempt for a weekly trend change on NVIDIA, right? But it hasn't been going so well because big tech has just been very unfavorable. Now, some people might say, isn't this a head and shoulders? Well, possibly, but where could we come down to? Maybe down here, 170 down about 160 area, which would be a classic retest of a formal support range and the infamous monthly 12 EMA that we pay so closely attention to on the channel overall. What has changed with NVIDIA's business model so far? Nothing. If anything, they've just increased guidance. Almost every month, Jensen says something or is at some conference increasing guidance, either him or the CFO. And right now, around 175 or low 180s, you're trading at a 1 peg, very decent forward price to earnings ratio, and excessively solid growth. So I love NVIDIA down here for accumulation, either for selling puts or for buying more shares. Moving on to Tesla right now. Tesla down 1.8% overall. Well, I guess we'll have to see what they say on their earnings come the end of January right now. But this one too, right? Since the delivery numbers were posted, has done nothing but only go down. That being said, what have they done in the past few months? Nothing. There's been some lows, there's been some highs, but they're the same price that they were back in September, right? So that being said, the bulls still have structure here on the weekly, looking for a weekly higher low, support below 430 down about 415. I'm not personally playing Tesla myself for the expansion. If you guys want to, it's up to you. I think there are maybe better risk to reward trades for short-term catalysts, right? I'm not saying anything about the long-term positives because that's what I'm holding my long-term shares for. Is it the best risk reward company in the market? Some of you would say so, right? I would possibly beg to differ, and I'm saying that as a Tesla shareholder. Yeah, they have super good, growth run rates for FSD, for Optimus Robotics, for their energy pipelines as well, and their services division too. But still, right, this one might be beholden to some of these short-term negatives from their car business, at least right now, because all the rest of this stuff, you got to wait a couple of years, right, for full FSD expansion, for full Optimus expansion, for full energy business takeover, right? All that stuff is a thesis measured in years, not so much in terms of short-term days or weeks or even quarters, perhaps. Moving on to Palantir right now. Palantir, same concept as we've been describing, right? Palantir's just stuck here in the gulag, 185, then about 170. The only notable thing would be a breakdown. If you break down below this line in the sand level, 166, daily downtrend, weekly as well, also would be bigger consolidation, and you might be able to find some nice short put opportunities down here, 150 to 140. What is Palantir doing? Well, they're just consolidating on the monthly, right? There's a huge rally, such an easy trade on Palantir all of 2024, all of 2025. And now for the past 5-6 months, they've just been consolidating sideways, which allows them to cool off their RSI and somewhat grow into their valuation. Not taking anything away from this business. I still hold some of my Palantir shares too, but maybe a better entry proposition, at least risk to reward wise, would be down here 150 to 140 if we do visit it. I'm not saying we're going to, I'm just saying if it does come down there, that's when you get me a little bit more interested. If you guys want to play this one for a breakout to the upside, it's completely up to you, but please do it with a stop loss, because if you lose this, there's really nothing here until down there in the 150s, yeah? So stop loss here, and then if you're trading for the expansion, you'd be going obviously for 210 break of all-time highs. Risk to reward is not too bad on that. I'm not playing it myself, just an idea for those of you that are willing to play it. SOFI down 1.73% today. I'll say it again. Some of you guys enjoy when I say this. What did SOFI do today? Nothing other than being part of the entire financial sector, right? And just getting dragged down with the rest. SOFI's done nothing. SOFI was a very popular trade all throughout 2025, very easy trade, a very trendy trade. In the past 5 months, what has SOFI done? Absolutely nothing. It's been great for those of us playing the wheel on it, selling put options down here in the 25 region and just milking premium for the past 4 or 5 months. But if you've just been holding long-term SOFI shares or holding leaps, maybe your leaps are bleeding out and maybe your shares are causing you to be a bit impatient. But I know some of you might just be accumulating for the next leg higher and do believe there will be a nice leg higher in SOFI, but not right now, possibly, right? 1.1 peg around 27, mid-sevens price to sales, not too bad. SOFI just accumulating right now, right? Oops, that was not a very nice line. Accumulation range, trap between resistance 30 to 28 and below support 25 to 22, which is the classic area from 2021. That being said, just healthy monthly consolidation. So still an accumulation range for SOFI. Shares, or if you guys are going for leap call options, wishing you guys the best of luck. For some accumulation, definitely the area that you want to be doing it in, though, here down to 22, or selling put options down here to farm some credits. All very nice opportunities. All right, 2 last ones, Uber and then TSM. So Uber, not doing too much of anything today, right? Just beholden to the entire tech trade, just being a bit soft. Still hunting for the daily higher low, anything above 79.50. Higher low, looking for further expansion into the great wall of resistance, 91 down about 87. Weekly, downtrend, right? Nice bounce, though, very nice bounce. Now they got to get it back. So in the event we consolidate a bit more to the downside here, I'll be playing some short puts in this location and also looking to explore adding some shares, right? On the weekly and on the monthly, you can clearly see what are they going for here. Just monthly consolidation into prior resistance, current support, and a low valuation around 80, low 20 multiple, 1.4 peg, 5.25% free cash flow yield, and expansion, very nice expansion of bookings, monthly active users, mobilities, and delivery segments, and $20 billion in buybacks with great free cash flow. So obviously, right, nothing has changed fundamentally on Uber. The only thing that's changed is the price. Moving on to TSM. TSM, 1.25 down today, but this doesn't matter. TSM has earnings tomorrow. So we'll take a look here at the expected move for TSM. I believe it should be about 5-6%. Let's have a look. Expected move for tomorrow. I'm mistaken. Sorry. 3.5%, 4%, let's call it, right? So 3.5%, 4% to the upside might put you north of 340 into the 350 area, and 3-4% to the downside might put you closer to the retest of previous support. So we'll cover TSM earnings on the channel tomorrow evening. Earnings is always a casino. We've seen TSM many times report very strong earnings and go down after, just like it happened with the banks today, right? Another quarter back here, positive lift after earnings, and then kind of gave it all back and went into this awkward phase of consolidation. So we'll see what happens. I'm still very bullish on TSM for the long term, but deriving, I think, if you ask me, first glance, the numbers should probably be very good. they'll show more demand, they'll show more profitability, they'll show pricing power, right? But how the market reacts to it, it all depends on the themes into tomorrow, right? Does big tech actually get a bounce tomorrow, or do we just bleed on the overnight futures, on the Qs, whereas all the other segments of the market do fine, just like today, right? In the event TSMC comes back down here, I might get a bit interested, right? 310 out of 300, backtest of support. So pay attention to what happens tomorrow. Maybe some actionable things tomorrow, depending on the price action. I'll let you guys know. If it does happen, we'll cover it on the channel tomorrow and derive some plans. And if it just leaves without us, well, I guess I'm just holding all my shares, but I'm not really adding any more up here on TSMC. And that is your overall market rundown. So that being said, let's cover a few of these themes today. But if you guys have seen my videos over this entire week, we've covered so many of these, maybe not on an individual basis, every single company, but the themes and why some of these companies are down. We've covered these a lot in the past 3 days, but we'll go over them again. We'll go over them again today for about the next 5-10 minutes, shall we? Okay, so just so we can cover a lot of these quickly, I'll just go over these names and the key themes, right? Anything software, still destroyed, whether it's even AAPL today, they were not safe. Anything tech and software today, not the place to be in as the rotation does continue. AAPL, if you guys are wondering where is the trade for me, the last time we talked about it was late November, 12 EMA, right? I know it might not happen. If it doesn't happen, no problem at all. I'll let it go. But at 620, the valuation is not terrible right now on a earnings basis, but keep in mind, this EPS number will be going down. So you might get faked out when you see this low PEG ratio. Price to sales, a better metric, and this is extremely high, guys. Extremely high price to sales, so you got to give me a discount. If you ask me where my most favorable location for AAPL is, it's 500. If it doesn't get there, there's tons of other opportunities. This is the location for me, but if you guys want to buy it up here, wishing you guys the best of luck. It is into some form of short-term support. Moving on to a name like Intuit, right? Software, once again, super high quality company, but just part of a segment of the market that's just been getting absolutely destroyed. Now, Intuit, the funny thing about Intuit, even here at about 580, where they are into support, long-standing support, right? It's the 50 monthly EMA. This does not get tagged very often on Intuit. High quality company, could be worth a pickup if it's your type of company, but it's not super cheap, right? It's still trading a 1.71 PEG, which is manageable in relation to the products that they have, the revenue growth, the free cash flow, and their margins. It's not that bad at all. So Intuit is an interesting play here if you're looking to add it to the long-term portfolio. But any swing trades, you might just be a bit disappointed from software's performance, maybe in the short term. So I think whenever we're talking about short-term trades, guys, you may as well stick to the key themes and the momentum that's working, right? Energy, minerals, defense names, stuff like that. That's when you get the best action out of short duration call options or debit spreads or swing trades with shares or whatnot, right? When you're looking for these kind of out of favor names with high quality business models, it has to be either long-term shares or very long duration, like leap call debit spreads and stuff like that. Because the turnaround is not going to be instantaneous, right? We talked about this yesterday with CRM and Adobe. Now, I'm not removing anything from these companies, right? Or even a company like ServiceNow or whatnot. Like they're arguably a lot cheaper than they once were. But once again, it's a sentiment issue. The fundamentals are cheaper than they were. The technicals are arguably oversold on a lot of these things in the short term, right? Or clipping into huge technical areas where it should be a buy. The problem is the sentiment, right? And the sentiment is not an easy thing to turn around. It's actually very slow, as a matter of fact. So keep that in mind. Shopify just down as part of the overall tech batch right there. Shopify is a buy for me, 135, 125. We talked about that last October. If it doesn't get back down there, no problem at all. There's tons of other things for me to play, but just something to pay attention to. We covered their earnings in November. We said at 160 where we are right now. It's a little bit expensive, let's be honest. A little bit expensive. I'm not saying at 135 it's not expensive, but at least it's a bit of a better proposition and a better technical level for possible entries. Even a Canadian company, Constellation Software, look at this one. This one was just pure growth, pure consistency for a while. Now this one is down like, 42% off the all-time highs. Even me, like I'm building a bit of a position in this one. Not a very large position, but a small nibble in some of my Canadian portfolios overall. Small nibble, but I mean, we're at a loss of everything, right? Weekly oversold, daily oversold conditions, monthly is just a pure falling knife right now. So anything that I'm buying, I realize that it might just be a very long time before we kind of round the corner here and finding a true bottom. Anybody's guess, right? 28, 26 maybe? Previous support? Because we definitely blasted through everything right now. So a lot of software names deeply out of favor. Duolingo is another one. Duolingo would arguably be one of my would be one of my last picks if I had to pick one, right? You can make an argument for their business model, you know, and I do agree with some of those arguments. It's just, you know, very much out of favor because of sentiment, right? It's technically oversold on so many things, weekly oversold, daily oversold conditions, you know, it's blasted through tons of monthly levels right here. It's down an astronomical amount from the all-time highs, 70% overall, arguably at 150. The stock is somewhat cheap on forward price to sales and PE. I mean, we did it at 205 and it was relatively okay at 205. At 156, it's even better. But once again, like you're going to have to wait a long time for this to turn around. Celestica and some of the other data center, you know, second order plays, whether it's networking components and things of that nature, right? They're still very high growth rates. Yeah. But I want these at the 12 EMAs. Sometimes you can find them close, like Credo. You know, Credo was 12 EMA recently, and we did pick that one up here. But a lot of these other ones are still, I'm not saying they're not cheap. Arguably, some of these are cheap. Like we did the valuation here. It's cheap on a PEG ratio basis, but this growth will not last forever. Price to sales is pretty good though, right? So Celestica arguably is an accumulation trade right now. Decent name. A lot of people ask me about it. There can be some further upside, right? But best would be like down here when you can line up the fundamentals with a beautiful technical entry. And don't tell me it's not happened in the past. Celestica's done this twice in the past, right? One more time. I don't know if it's going to get there. So maybe if you want this one, maybe you buy it with the premise of DCAing down there if it gets down there, understanding the valuation is cheap. Definitely momentum is not a problem right there. So there's many, you know, second order plays such as these or such as Vertiv, right? Also from here down into the 12 EMA, second order plays, as you guys well know, right? Whether it's cooling or networking components or cables or stuff like that, right? All things that are highly needed from these semiconductor companies overall. Twilio, another SaaS player that's down right now. Airbnb, this one was wild today, right? A lot of the travel names like this one, Booking.com, getting crushed. I think this one is, some of these are like very good buys because travel is going to be probably very good in 2026 and 2027, at least if we follow the company's guidance that they gave us just about a quarter ago. Booking.com, this one's a buy for me. Airbnb down here into the pocket of support, 132 down to 125 is a buy for me, or selling some short puts down there. Very decent. Zeta, we talked about this one a lot. This one is a new pickup from me. I'll be looking to build a position from here down into maybe the low 20 or lower 20s or sub 20 location. Decent price to sales, 3.5. I know I'm going fast on these, but I kind of said I would be going fast, right? Zeta is indeed a buy for me. FLNC and EOSE could be very attractive battery storage plays for energy deployment purposes, right? These are going to be very hot plays probably into their mid caps, right? $4 or $5 billion companies with great revenue growth prospects and in line with the thesis for this year. These could be very interesting as well. A-Lab, another second order play for the data centers, right? A-Lab as well here down to like 12 EMAs on the monthly. Decent propositions as well. You can make an argument for it. Affirm, the broadening out of the consumer. They've been taken down because of the because of the banks and the credit card companies, right? It's taking down Affirm. Affirm is back into the buy location, lower 70s down to mid 60s. Phenomenal location, in my opinion, at 70, right? We've done this before many times. Low PEG ratio, very low, and low price to sales with phenomenal user growth and multi-metric growth as well. So this one is a buy for me as well. Visa, MasterCard are buys as well. Oracle is like my least favorite data center play. I'll just be honest. You know, the whole NBIS, IRN, APLD, CIFR, I mean, take your pick, right? Mine are NBIS, IRN, and CoreWeave. But if you guys wanted to broaden out for some of the smaller ones like CIFR or APLD or Wolf or other ones, I'm not going to cover each and every one. I'm just saying the ones that I prefer. Those are nice accumulation zones because of the chart that I've drawn on Oracle, right? 2025 was the big money funding phase. Now we're in the execution and building out phase of these data centers. And then end of this year into early 2027 will be the monetization of these data centers. So now you're in the dead zone, right? Where things are just kind of moving along and there's not many big new deals being announced and everybody's just building data centers in the background, which is why the price, there's no big headlines for them, right? So you can make an argument for Oracle down here, and I might agree with them, but Oracle is not my most favorite play overall. I've been very vocal about that on the channel just because they're massive debt loads overall, and my reluctance to believe that this entire RPO pipeline is actually real, especially the component coming from OpenAI. There's a lot of client-specific risk there. Broadcom is indeed a buy for me, especially if we move from here down into the 12. So from here into the 12, it's a buy for me. On Broadcom, we said that after last earnings, around 325. Valuation is very strong in my opinion. Not strong in relation in saying that it's expensive, but I mean, it's a strong proposition for a buy. a one peg, right? Not too bad. Price to sales is a bit elevated right there, which is why I say here down through there, I think Broadcom probably has another nice leg of expansion. But now it's not as easy as it was back here, right? To make Broadcom run, it's a 1.5, $1.6 trillion company. So obviously it's not as easy to make it run as the other ones. And then there's many other names such as the cybersecurity sector, which keeps getting destroyed day after day after day, but I'm still very bullish on names like Rubrik, on names like SentinelOne. You can even make an argument that CrowdStrike perhaps is coming into buy territory. Personally, I like the low 400s on a CrowdStrike. Palo Alto Networks, for me, I'm like a 170s guy myself. You can make some arguments for cybersecurity. If you don't want to play them as individual names, you can always play them as a group using an ETF. That's my preferred method as well for cybersecurity. If you don't understand the differences between all the companies, just don't want to put in the work, well, then maybe an ETF could best serve you overall for those purposes too. I think we've done a good job covering mostly everything. You guys already know my stance on some of the energy plays, especially the independent power producers such as Vistra and other producers of that nature. They're very solid for me as well. I do enjoy those coming into this year as well. I think that's everything. We've covered a lot of these at other times throughout the week, so I'll kind of just jump into the biggest gainers of the day, and you guys should not be surprised, as we said in the early portion of the video, right? It's just more of the same. Critical minerals coming alive because of the discussions with Greenland, even though nothing was said about critical minerals in Greenland. But this is going to be a very hot narrative again in 2026. You saw it late 2025 with the rapid expansion of MP materials, and now we've just been waiting for healthy monthly consolidation into where, oh look, is it not the 12 EMA on the monthly time frame? Is it not the 12 EMA on the monthly time frame again, right? Very curious how that works. If you guys want to know why I use, you can use the daily. It's just the monthly just makes more visual sense, yeah? 12 monthly EMA is more than often always the 200 daily EMA, okay? That's where I want to be buying. Yeah, it's where a lot of institutions also want to be buying too. So keep that in mind. MP materials could be interesting. Obviously, this is a long duration trade thesis, whether it's MP, whether it's UUU. Obviously, there's many more that we can talk about too, but these are the ones that are the most popular names. Could be a nice theme into 2026. Just if you're playing momentum, try and play with a stop loss, but understand that these companies need a long time to broaden out into their actual revenues, right? Moving on further, space trade's still very hot, but it's so tough to buy space up here, guys. It is so tough to be buying a company like Rocket Lab up here. You can only buy this if you have a multi-year thesis. If you think that it's going to become a $150 billion, $200 billion company down the road, it's not there now. They can't really support. You know, we did this valuation after their earnings, you know, when the stock was what, 54? And now the price of sales, like, they just don't make sense. On a short-term basis, like, it's impossible to buy these for a short-term basis. Yeah, it's impossible, right? And even the most diehard Rocket Lab fans will probably tell you that. It's a $50 billion company with $1.5 billion of revenue into 2028, which is why I say, if you're buying this one, you got the Palantir thesis. It's multi-year thesis, and you have to understand that if you're buying up here, you might have to DCA if this trade does unwind. Same can be said about a trade like ASTS as well, so we won't belabor the point right here. I'm pretty sure you guys understand. AVAV, very interesting. Drones, right? Drones, military purposes, very interesting. There's many key themes here. We said as well earlier throughout the year, this entire week so far, key theme, but it is already up a ton since the start of the year, 57%. This is the same concept, right? It's a $19 billion company, but just always watch your price to sales to understand if you're getting a good deal or not, right? You're not getting the best deal. You're getting an okay deal, but you're not getting the best deals. 10 forward price to sales for the next 2 years worth of sales. It's decent, not as good as people who bought it back here. It is still buyable and is still on theme, but you wouldn't be surprised if it's very volatile, right? They can get sent down. If there's a rotation back into this stuff in a big tech and otherwise, well, the money's going to come out of here, right? So I hope you guys are willing to buy the dip and stick with the key themes for the next 2 years. And the same can be said about many other things out there, right? You know, obviously Intel, we talked about Intel a lot after their most recent earnings. Intel it's coming to the territory where it's still cheap. We did it at 40 bucks. It's now 20% higher. So it's like a one peg, but EPS growth is coming off of 0. So this is not the best. Price to sales is not terrible, right? Intel is a multi-year thesis again. You're counting on the recovery story of the entire company, backed by the US government, multi-year thesis. Is it the best risk reward entry? No, that was back here. We were very clear on that, right? Can you still make some money if you buy it up here? possibly, probably right, but you won't get as good compound annual growth rates of people who bought back there and people who bought here either. So keep that in mind. And then it's just a whole bunch of more of the same, right? Oil companies, you're very clear. If you don't want to play individual oil companies or you don't want to search for pipelines in terms of natural gas, you can always play the breakout on XLE, leap call options, shares, however you want to play it, and things like that. So all the same current themes, right? And if you're not willing to play Lockheed Martin all the way up here, massive breakout there. General Dynamics all the way up here, RTX all the way up here. These are nuts, right? NOC, Northrop Grumman all the way up here. Well, maybe you kind of look to the small or medium cap names that we kind of referenced earlier on in the video, or maybe you just go with the ETF, right? To kind of get a whole bunch of everything. But these are running a little bit hot right now, so you wouldn't be surprised if they do have to cool down a little bit in the near-term future. But it's just a whole bunch of value, right? If you don't know where to play value either, you can also just play a dividend ETF like SCHD. Look at SCHD, right? I mean, you don't have to play, but you know, there's some interesting ones paying dividends, right? Kimberly-Clark. Just, you know, they do many things, but you guys might remember them. Whenever you go into a public bathroom, you got the toilet paper roll sitting right next to you. Just look, the metal toilet paper roll holder, it probably says Kimberly-Clark on it. This one, 2014 lows, right? Pays a 5% dividend. Names like Altria pulling back into support. This pays a 7.25% dividend. Names like UPS, which are multi-year disastrous lows in the midst of a turnaround story, right? 6% dividend. So you can find these dividend plays all over the place, provided you know where to look, or you can just go with a dividend ETF, which has been doing nothing for the past few years, right? That's not a bad proposition either. So you don't necessarily need to pick and choose across these different companies. You can go for ETFs if you just wanted to make your life super simple. ETFs for defense, ETFs for consumer staples like XLP, or just going for the overall dividend plays, ETFs for nuclear energy plays, or ETFs for oil and energy plays as well, XLE. So you can play these on an individual basis, and I'll tell you guys what my favorite names are on an individual basis when we cover them. But you can also play ETFs, and there's nothing wrong with that if you wanted to participate in the overall narratives. And we haven't even talked about robotics today, but we'll reference it more and more in the next coming videos in the next coming weeks as well. But that's everything I had for you guys today. Another very big video, but you know, start of the year, I'll make these. I always give an excuse as to why the videos are long. Sometimes it's because we're in a market correction. Sometimes it's because we're in an earnings season. Sometimes it's because we're in a rotation phase of the market that may not make much sense to people. But hopefully you guys get good value out of these videos, because that's why I make them. So apologies for the length of the video again, but it is what it is, I guess, at this point. I guess I've kind of backed myself into the long form content niche of YouTube. So it is what it is, man. Thanks so much for watching, guys. As always, my pleasure for the videos. Hopefully you enjoy them. If you do enjoy them, consider dropping a like. Would appreciate it for the growth of the channel, because the algorithm definitely isn't going to favor my hour-and-a-half long videos, right? So I'm counting on you guys to like the videos, subscribe to the channel if you enjoy these videos, and also leave some comments down below to help me out with the algorithm again for some engagement. Comment on some aspects of the video that may not be clear to you. If you have any questions, if you have any comments, any feedback, or if you're looking at any thematic plays or other plays, definitely leave them down below in the comment section. I would love to hear from you. That's all I had for you guys today. Hopefully you guys have a good day in the markets tomorrow. Take care. Have a good rest of your evening. Peace.